Hi everyone, I'm Simon King, National Director of Business Development at Fries. On behalf of Fries and Western Union Business Solutions, I would like to welcome you to the third of our Brexit Week webinars. We are privileged to have on our panel of experts today from Fries, Iain Bowler, National Head of Commercial at Fries, and also from our commercial team, Nicola Cooper, Managing Associate. From Western Union Business Solutions, we have Mark Williams, Senior Channel Partnerships Manager, and Chris Weeks, Senior Corporate Hedging Manager. We will shortly begin the panel discussion, but before we do so, I just want to confirm that there will be an opportunity to submit questions during the talk, although we have had many submitted beforehand. So please do so, as we want to make this discussion as interactive as we can. You can submit your questions via the Q&A function on Zoom during the session. If unfortunately we do not get round to answer your question, we'll follow up with you directly over the next few days. We'll also be running a number of live polls throughout the discussion. The results will be available in real time, so I would be grateful if you can all participate. As we reflect over the last year, there have been lessons learned, and it is clear we must be adaptable to change to not only survive, but also thrive and beyond these difficult times. Right then, panelists, we all know that the last 12 months has been a difficult period for many businesses, and the twin hits of the COVID-19 pandemic and Brexit has had a significant impact on supply chain resilience and has or will stress test even the most robust risk management strategies. So I would first of all like to hear from Mark. What have businesses been telling Western Union about the impact the pandemic and Brexit has had on them, and what effect have you seen across global markets? Mark.
Thank you, Simon, and good morning to everybody who's joining us. So if we rewind to the start of 2020, when the pandemic first broke out and impacted China as the first major economy, as the Chinese economy wound down and the factories closed, the knock-on effect hit the rest of the world pretty quickly, and it became apparent that we were slightly overly reliant on Chinese supply, and that there was a need to look at further diversification of supply chains. And to give you an example of this, it was evident in the automotive sector, where companies such as BMW and Jaguar Land Rover are reliant on Chinese supply of parts and components that go into these vehicles, but where these weren't leaving the Chinese factories, companies like BMW and Jaguar Land Rover were forced to close their manufacturing plants, which knocked on to delaying the orders that they were seeing. And we also saw, as the demand for PPE grew around the world, as the pandemic became more widely spread, the world turned to China for cheap supply of mass PPE equipment, but the demand for the PPE equipment far exceeded the ability to supply. This had an impact on prices and an impact on supply chain. And in a panic, the UK turned to other routes of supply. They turned to Turkey as an example, spent a lot of money on PPE equipment from Turkey, which landed in the UK, but was not fit for purpose and is probably still sat on an airfield somewhere. It sort of highlights the need to have a diverse supply chain and have more than one option for supply. It's now been recognised that, coupled with the opportunities presented by a post-Brexit trading world and potential new trade deals, that there is an opportunity to diversify more broadly our supply chains. However, it's still open to question as to whether we will truly see this. Although it was the first heavily impacted economy in the world, the Chinese economy was the only economy not to shrink, last year, and is actually still forecast for significant growth through 2021 and beyond, as the demand for cheap products still remains high, and this continues. So I think we'll see a lot this year in terms of the willingness and the appetite to truly diversify and source product from alternative nations and trading partners. But looking at this year and where we are now, we are still seeing some challenges to supply chain caused by the pandemic, and also in part by Brexit, creating somewhat of a perfect storm. Quick goods rebound has meant that the ability to supply and meet the demand is shortfalling in a number of areas, particularly within more complex products and within more complex industry sectors, such as electronics, automotive, pharmaceutical. And there is also a short supply of many metals across the world as demand for some of these products increases. So we've seen a lot on the news recently about electric vehicles, etc. They demand quite heavily on copper, and therefore there is a shortage of supply of copper around the world. So, you know, we're seeing this having a knock-on effect onto supply chain within certain sectors as well.
Thanks, Matt. That was a great insight. Iain, what have you seen from a legal perspective?
Well, good morning, everybody. So I think, you know, I'd echo a lot of what Mark's just said, not surprisingly. I think, you know, in terms of what we're seeing with a good number of our clients is that the impact of Brexit and the coronavirus has brought, you know, supply chain resilience to the top of people's minds, particularly those who over the last few years have spent their time, you know, consolidating supplies into low-cost manufacturing areas, particularly China and the Far East. You know, I think a number of businesses feel that they've caught a bit of a cold with that strategy, but I don't think they're ready to abandon the strategy, but realise they've actually got to rethink a situation where, you know, they've put all their eggs in one basket, maybe. You know, I was talking to a lighting company, and they were telling me that you know, they have this huge deal with a Chinese manufacturer, huge factory that provides all of their products, and it's based in Wuhan. Not a great place to have your only supplier in March and April last year. So I think as a result of that, many businesses are scrambling to try and shorten the supply chains or to diversify the supplier base geographically. And I think, you know, Brexit causing delays at borders has also been a further disruptor. So you've got this issue in terms of, can you actually get the product into the country? And then you add to that the uncertainty over cost increases. You know, we got you know, increased costs resulting from additional customs compliance and the effect of adverse currency fluctuations. And as Mark said, you've really got a perfect storm where you're unable to supply your own customers because you don't have the products or you don't have the components to manufacture into the finished goods that you're then going to sell to your customers, whilst at the same time you're having to absorb cost increases which impact profit margins, or try and work out how you can pass those cost increases onto your customer base. You know, that's looking upstream. You then look downstream, you know, in terms of how you continue to supply your customers and the additional risks that you're facing there. And I mean, Nicola, you've got, you know,
yeah, and I was just going to follow up on that and just say there's been quite a lot of focus on force majeure. I don't think commercial lawyers can talk about the pandemic and not mention force majeure. It's something we've focused on quite a lot over the past few months. In that suppliers have been looking to get relief under a force majeure clause in, you know, when they are unable to supply their customers under their sale contracts. So it's just an important point to note that you know, force majeure isn't a UK concept under common law, so you can't just assume that you will have that ability to rely on that. You know, it is in the devil of the detail in the contract, so it is important to sort of take note of what your contract actually says. I think a lot of times it's sort of shoved in the drawer and never looked back on, but it is in the detail, I'm afraid.
Excellent. Well, thank you all of you, all three, for some really interesting perspectives on the key learnings we can actually take away from the pandemic and Brexit. This neatly brings us on to our first poll of the session. We'd like to hear from you, the audience. How has the uncertainty driven by Brexit and the coronavirus diversified your supply chain? Have you sought to diversify nationally, internationally, or both? So if you can start voting, please.
Wow.
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 Wow, that's quite surprising, actually.
Nicola, what do you think? It's quite an even split overall, isn't it?
I'm surprised that there's 38% not at all. I thought there would have been more sort of internationally and nationally rather than not at all, but I'm guessing this webinar might sort of provoke some food for thought.
Good. More food for thought for all of us, perhaps.
It'd be interesting, not to get into something, but it'd be interesting to understand whether actually the not at all is partly because, I mean, I likened this the other day to, changing your supply chain is like trying to stop a supertanker. And it's not something you can do quickly or necessarily very easily. So it'd be interesting in terms of follow-up to understand what's behind that not at all, whether it's just because you don't think you need to or because it's just in the too difficult camp. Anyway, let's move on.
Or it may be working, you never know.
Yes, absolutely, good point.
Thanks, Iain. The next question is again for you, Mark. We would be interested to hear your thoughts on how the markets were impacted by the pandemic and Brexit during the last 12 months. And what are you and Western Union forecasting for 2021?
Well, I think the short answer to that, Simon, is fairly significantly over the last sort of 9 to 12 month period. If we look back at the initial market response to the pandemic and to Brexit, markets were previously quite politically driven before the shock factor kicked in. And the shock factor of not knowing the sheer scale or impact that the pandemic was likely to have on economies around the world created heavily risk-off trading conditions. And with the pound being a risk-on currency, i.e. a currency that performs well when there is decent level of risk appetite across markets, we saw some significant and quite sharp devaluations, which no doubt the exporters that are with us potentially enjoyed through periods of last year, but presented equal challenges to the importers amongst the business community. And it wasn't just the FX markets that were impacted. We saw tumbling stock and equity markets. The pound actually suffered its sharpest decline since 2016, which was, of course, the year of the referendum, and we actually saw multi-decade lows for the pound against the US dollar for a short period of time, traded at 114. After a period of time, as we started to understand the pandemic, and particularly as across the world and here in the UK, we saw some fairly significant and unprecedented financial support packages launched to support business and to preserve employment. The market started to accept the situation and look towards recovery and outlook. It was acknowledged that any recession would be very deeply felt but short-lived, and markets began to cover. And because of the sheer degree of fiscal support and stimulus that was pumped into the economy, stock markets actually recovered to reach record highs, which is quite unprecedented because there was then the disconnect between market performance and consumer and business confidence, which normally trade reasonably aligned. But actually, at a time where business confidence and consumer confidence was quite low, we found that equities were performing quite well, and markets were trading at really, really high levels. What we have learned about the stimulus packages and the financial support is that they have served purpose well in terms of limiting the damage caused by the pandemic and the deliberate closing of economies. Although unemployment has been creeping up month on month, it still remains at a level that is far lower than the Bank of England forecast it to be at its peak, which is now, I believe, in the third quarter of this year. And the trend that we're now seeing is that because it is accepted that whilst we are still operating through the conditions that we are at the moment, key macroeconomic data is almost being ignored. It's being looked at in the respect of, is it as bad as we thought it would be? And in some cases, it's not. We in the UK have avoided a double dip recession. The economy is forecast to shrink in the first quarter of this year, but it is also forecast to return to growth in Q2. And as markets and market confidence looks forward, we're being driven by the outlook, the ability for the economy to recover, and the success of the vaccination process. And from a UK perspective, the UK is leading the world in its vaccination programme and the success of the vaccination programme. And that leads to confidence that the UK economy could recover and grow quicker than some of our global counterparts. And this has meant that actually, you know, the market impact is quite visible. The pound has recovered to a point where we've gone from multi-decade lows against the US dollar to near 3-year highs over a period of 9 months. That represents a trading range of 28 cents, which is pretty significant. And whilst the risk at the moment appears to be more to the upside, i.e. the pound is well supported, markets are trading with optimism, it's anticipated that we could see further strength. So the risk remains to the upside of that trading pair. I think it also shows us how quickly sentiment can change, and we don't know exactly what is around the corner. Of course, the roadmap that was delivered by the Prime Minister on Monday helps, as will the budget next week. But risk remains on both sides. So, you know, regardless of what side of the market you sit on, it's still something that's important to take note of and manage according to your situation.
Thank you, Mark. Now, Iain, what are you seeing from a legal perspective, and what are you forecasting for the year ahead?
What am I forecasting for the year ahead? That's a very good question. I'll come back to that in a bit. But in terms of, I mean, I would echo really what Mark said. I think if we, in terms of a return of confidence, I think, you know, if we go back to you know, March and April last year, you know, there was huge uncertainty. We were going into first lockdown in terms of coronavirus. You know, the Groundhog Day that was reporting on the Brexit negotiations was just churning, you know, a relentless wheel that was giving out, you know, quite negative vibes. And I think, you know, throughout most of last year, business confidence was impacted by, you know, by a combination of both of those things. I think, you know, in terms of, you know, sort of the coronavirus, I mean, you know, Mark just talked about the vaccination program, the Prime Minister's announcement on Monday in terms of the roadmap. But I think one of the things for business in particular that is going to influence and impact the economic outlook in terms of this year is actually the fact that we got the trade and cooperation agreement at the end of last year. I think that removes a significant level of uncertainty for businesses. You know, I mean, there's still a huge amount to wade through. I mean, it was a 1,200-page contract, and if people in the audience feel when they get their draft contracts drop into their inboxes, you know, and they see sort of 40, 50, 60 pages, and their heart sinks. Just think what it must have been like to receive a 1,200-page contract. But you know, I think the free trade deal part of that, 3 elements really to the trade and cooperation agreement, but the free trade deal, you know, although it's no match for the level of economic integration that existed whilst the UK was an EU member state, the free trade deal does create a zero tariff, zero quotas regime for many products, not all products, and it's a significant improvement over where we would have been in terms of the WTO position had the trade and cooperation agreement not been put in place. Just picking up on that point where I say it doesn't apply to all products. The free trade deal only applies to, excuse me, products that comply with the rules of origin. And I'm not going to go into the detail of that now because part of 50 of those 1,200 pages covered the rules of origin provisions. But basically, if the products that you're looking to move between the UK and the EU satisfy the rules of origin provisions, then you're into zero tariff, zero quotas. If not, then you still fall back onto WTO rules. So it's going to be really quite important just to check which, that your products do comply with the rules of origin. And I think the other thing that's going to increase confidence, is the simplified customs procedures that are set out in that agreement as well. The trade and cooperation agreement provides a basis for simplified customs checks at UK borders. The rules, as a lot of what's in that agreement at the moment, are quite vague at this stage. There's more work to be done to actually flesh them out, and there are customs checks being applied to all products, which is causing delay and disruption to the supply chain. Although I think the level of disruption does seem to be calming down a bit now. I think there was an initial flurry in January, and actually there's a little bit, it's leveling out. And it's also worth just noting that the rules for Northern Ireland are different. I mean, people who export or pass goods between GB and Northern Ireland need to be aware that products moving from Northern Ireland to GB, there's no new customs procedures. Although for European manufacturers, there are provisions that prevent them using Northern Ireland as a channel to place goods on the UK market without going through the customs provisions. But in terms of the supply of goods from GB to Northern Ireland, you are now going to have to complete a customs declaration. So I think all of that and the general proposition in relation to new trading agreements, is going to create is already creating a quite a high degree of confidence, I think, within business. So if we look at so at the end of December, the UK had 2 trading agreements in place, one with the EU, which of course is the UK's biggest export market, and also with Japan. But there are also 32 trade continuity agreements in place. Now, what those trade continuity agreements do is, on an interim basis, they preserve the EU free trade agreement between and make that agreement between the UK and, for example, Canada. There's a continuity agreement in place with Canada. So, the EU, at the end of December, the EU had about 40 trade deals in place covering 70 countries. The EU currently has trade deals or continuity deals in place with 63 of those 70 countries. So we're not at all in a bad place. There are some noticeable gaps in terms of what the UK is focusing on. US, Australia, and New Zealand. Canada and Mexico are also noticeable gaps, but there's talk about the Trans-Pacific Trade Group. And if the UK joins the Trans-Pacific Trade Group, for example, that would bolt us into an existing trading agreement with Australia, New Zealand, who are 2 of the key targets, and potentially the US. So I think a good cause for increasing optimism, I think, as we go into 2021.
Yeah, if I might add to that particular trade group is quite key, because obviously essentially currently consists of it's an 11-nation agreement, which would provide us with 11 trade deals. If the UK's application and the US's application is accepted to join that, the US trade deal was something that was put in front of us as one of the biggest post-Brexit trade deal opportunities, and it could provide a bit of a back door into a free trade deal with the States, which is one of the things that was cited as one of the benefits of leaving the European Union. And just to back up your point there, Iain, on the free trade deal with EU. That was absolutely critical in terms of the strength and optimism going into this year. We saw significant shifts in markets on that front.
Great, thanks both. It's good to hear some positive news for businesses in the year ahead. But as we know, whenever there's opportunity, there's also risk. And I would like us to discuss what businesses need to consider from a risk perspective when trading overseas. Nicola, I'd like to hear from you on your approach when speaking to clients who trade internationally on how they ultimately reduce that risk.
Thanks, Simon. So one of the areas that I've been looking at with clients is sort of building in mitigations in existing contracts, but also future contracts as well. I know that Iain sort of touched on this earlier, but it's all about recognising and increasing costs on suppliers due to the added complexities and requirements, at the borders, and extra form filling, etc. Someone referred to this as admin hassle the other day, which I thought was quite appropriate. But it's just to point out that if your contract doesn't allow you to sort of share those costs with customers, or indeed pass them on, then suppliers will foot that bill. So it's about, again, the devil is in the detail, and sort of building in those risks again. And then the other point is sort of delays in deliveries. So I imagine a lot of suppliers will be facing a problem in meeting delivery timescales. So it's recognising in your contracts where you might have obligations to deliver at a certain time or a certain date, and and if you're failing to meet those, you might be at risk of breaching the contract. So again, it's just sort of recognising where those risks are and mitigating them, not only in existing contracts, but also future contracts as well.
Excellent, thank you, Nicola. Now, I'm going to stay on the area of risk and risk management. And I would like to hear from the panel about what they consider is needed to create a resilient supply chain and robust risk management strategy. If I can first of all get the thoughts of Western Union. Chris, one for you.
Yeah, I think with regards to FX risk management, uncertainty has been crippling for businesses over the last few years. We've heard a lot about that recently on this call. Now, that could be Brexit, could be COVID, or any other kind of situation or business challenge that we've had. And creating a structure around managing FX risk is viewed as more vital now, given it's one piece of uncertainty we can control and politically and potentially mitigate in a world where actually there's so many variables. Many solutions exist to protect the business from currency risk, and many of you will have used some of these potentially. But as Mark spoke about earlier, the volatility has been particularly high, and that sometimes leads to almost a conundrum of how to protect, but also not limit yourself from any positive movements in the market, depending on what side of the market you are. And that actually may come down to the design of the overall strategy as a whole. Within our business, strategy is created collaboratively, and I'm really a big champion of that. And we break it down into consultation steps of kind of 4 processes really, which the first one is understanding, and that's a key one. So understanding currency exposures, risk, appetite, experience, etc. Then going on to identify what the specific business goals are, what are the objectives, are there any inefficiencies, are there any FX that we can potentially net off and remove that risk completely, because that's a very valid point. If there is a strategy required, then we look forward to executing that. So that might be just a product, or it might be an overall strategy which incorporates 2 or 3 products to meet your overall objectives. And then a really important one, which is something that sometimes gets forgotten about quite a bit, is the review process. So it's ongoing review really. It's set by the client, and that mandate there regarding when we catch up, when we discuss how the strategy is performing, but also it gives us an opportunity to realign on the kind of business requirements. Now, in a world of unenviable business uncertainty at the minute, where the environment is almost, even ever more competitive, and FX movements can really make a significant impact on bottom lines. Decisions around currency can really be a lonely place to be. Now, from my opinion, an ideal strategy shouldn't encompass an all or nothing approach, but should be tied to a specific business objective or a measurable. And in a normative world, a strategy should be robust enough to protect, but flexible enough to benefit from positive movements. But obviously, I appreciate we're not in an ideal world right now. So the key there really is to make it as bespoke as possible to the client's desired outcomes.
Great, thank you, Chris. Iain and Nicola, what are your views on what's needed for a resilient supply chain?
Shall I go? Yeah, I'll go. I'll start. You chip in.
Yeah.
So, I mean, I think in my view at the moment, it's about really about planning and provisioning. I think that's the most sensible thing you can do at this stage. I mean, I don't actually believe there's such a thing as a risk resilient supply chain. But what you can do is use, each disruption, whether it's Brexit, whether it's coronavirus, whether it's the next thing that will inevitably come along. Technology is a huge disruptor, and actually will disrupt the supply chain just as much as Brexit has, if not more, but in fact a lot more. And so you use each disruption as a learning experience, I think, to help you, respond in an agile way and figure out, durable solutions for the future. And as Chris just said, it's not just about how you move your products about, but the sort of having flexibility and being agile in the way that you look at how you're financing that supply chain is crucially important. So having said that, I don't believe there's such a thing as a risk resilient supply chain. What can you do to protect your business? And it's easy for me to speak as a lawyer. For lawyers, it's all about risk. And what you can, there's only three things you can do with risk. You can either eliminate it, manage it, or mitigate it. And actually, if you eliminate a risk, you usually create a new one. So that's never a great idea. So you end up managing or mitigating risk fundamentally. And you manage risk usually through building in, by creating contingency plans, by building in redundancy into your system, so into your supply chain. If there's a cost benefit analysis, you build in redundancy, you add cost. But if that redundancy causes your supply chain to be much more robust and means you don't actually have a 3-month non-supply of product because the only factory you've got in Wuhan has been closed, to go back to my earlier example, then the extra cost is probably justified. And actually, the other way you manage risk is by allocating risks between supply chain parties through your contracts. You mitigate risk by putting the risk on other parties, and a good example of that is insurance. You might take out business interruption insurance, and there's been a huge amount of debate over the last 12 months as to whether a business interruption insurance actually is going to pay out for loss of profits due to coronavirus, for example. But looking at these these risk mitigation and risk management strategies, really is, I think, how you start to build a much more robust supply chain. Building in contingency, building in redundancy, reducing dependency on a small number of suppliers, and certainly moving away from exclusive or soulless supply arrangements, as I think we've seen a lot of that over the last few months. Creating a more diverse supplier base, and considering new ways of working. I mentioned technology. Do you have to continue to work now as you have done in the past? What technology is there out there that will help you de-risk your supply chain in the future? It might be financial instruments, it might be blockchain, it might be autonomous vehicles, and things that actually technology that's just going to make the supply chain easier to run. But I think one of the key risks that actually businesses are going to face over the next 12 months is insolvency, the insolvency risk of suppliers.
Yeah, I'll just chip in there, Iain. So one of the I've been working with a global manufacturer quite closely for the past few months, and one of the things that I've seen is a lot more focus on doing research when it comes to taking on new suppliers, in terms of seeing what's in the press, if there's any recent restructures to suggest something might be going wrong somewhere, or personal parent company guarantees, putting them in place and just sort of building in additional securities, but also a big focus on the contract mechanism, so the governance under the contract, so having regular discussions and just keeping that conversation open so that you can recognise issues before they really get to become a problem. monitoring KPIs and service levels. Again, it comes back to a lot of the time the contract gets shoved in the drawer, but that's what it's there for, to sort of prevent these sort of issues. So I think it's a lot of planning, but also monitoring things as they go along.
I think it's a really good point, Nick, and I think one of the things that I have seen in the past as well is it's all well and good to set up monitoring processes. You can put arrangements in place, for example, where you have suppliers, self-certify in terms of breach of KPIs or service delivery failures and so forth. But actually, if you don't police those provisions, you let breaches of KPIs or service level agreements go by week after week, month after month, and then 12 months in, you decide you want to start enforcing these provisions because actually it's starting to go a bit pear-shaped. You're going to find yourself in a tricky situation. And I think you made a good point there, Nick, about monitoring the external environment, and looking at what's going on. I mean, one of the things, there's been quite a lot of cost increases recently coming from the strangest of places. I mean, you mentioned to me about the client you've been on secondment to, something about containers and actually what the impacts there.
Yeah, so one of the issues I thought they might come across was a problem in, access to raw materials, but actually there was a problem with access to containers, which I was quite surprised about. I don't know if, Mark, you've come across that issue at all.
Yeah, I mean, one of the things that was reported to us by a number of clients was the quite substantial increase in the cost of shipping goods around the world, and it's become apparent that there is a shortage of containers, which is creating a bit of a supply and demand market. There are containers that are stuck in places like South America that actually should be on docks in China, ready to ship stock around. And this is not a UK PLC issue or a UK business issue. This is very much a global issue. And ultimately, where the demand is exceeding the ability to supply, that's having a knock-on effect onto the price of shipping goods, and some businesses have reported to us as much as a 5-fold increase in the cost of shipping products around the world. And that in itself obviously has an impact either on the pricing and competitive nature of goods within industry, or bottom line and margin, which only throws into the mix further importance of addressing other areas of supply chain that can be controlled and can be risk mitigated as much as possible.
I mean, I think, Simon, just coming back to the question, how about creating a robust risk management strategy so far as it goes to your supply chain. I mean, I think one of the key issues for me, and it's a soft point really, it's not a legal point, but it's trying to create a congruent approach with your key suppliers to help avoid. I mean, Nicola mentioned early warning signs. But if you can create that sort of congruent approach, you can have open and regular communication with your key suppliers, so that you can avoid and prepare for and mitigate the effects of any disruption, whatever the next disruption is going to be, because it will be there. If you're prepared for it, then you're going to do better than those that aren't prepared for it. And this point about communicating with key suppliers, I mean, you'd be amazed. I'm amazed how many businesses don't communicate with their supply chain unless things start to go wrong, in which case it's often too late. I mean, you wouldn't dream of not communicating with your key customers, but if you've got no products to sell, there's no point having customers. So you should be communicating with your key suppliers just as much as you're communicating with your key customers. And I say, trying to build that congruence really within the supply chain. That's one of the best ways to be robust, and that's be ready, be prepared, and have early warning systems in place so you can see a problem coming before you open the paper on a Wednesday morning and find your key supplier in Germany has gone to the wall, and that's the first you've heard of it.
Excellent.
I think that's, sorry.
Excellent point.
I think for me, what's really come through to me in that discussion is that risk is formed of both opportunity and uncertainty, but clearly we need to manage both actively. Let us move on to our second and final poll of today's session. How are we looking to diversify your supply chain? Are we going to encourage collaboration with your existing supply chain, change to a sole supplier, change to a multiple supplier, collaborate or merge with the supply chain, leaving as is and making your existing supply chain more resilient? I'll give you a minute to open those. That's really interesting.
Great deal of variety of response there, isn't there?
Collaboration I'm seeing a lot of, but I'm sure, Iain, you're seeing a far wider spectrum than I am.
Yeah, I mean, it's. I'm really pleased that nobody's looking to change to a sole supplier. But you know that is a complete turnaround on the position 24 months ago, 36 months ago, when there was a huge amount of that going on. But I think what's really interesting there is actually the point that I was just alluding to, really, which is communicating with the supply chain and actually trying to get the supply chain to work more collaboratively with itself. I think that's really interesting. That's not actually what I was expecting. I was expecting change to multiple supplier or leave as is and make more resilient to be the biggest part of that. So that's really encouraging, and I think demonstrates a degree of engagement. You know, a really good degree of engagement in terms of how people are trying to address the current situation.
Excellent, thank you, Iain. That brings us to the end of the panel discussion, and now we can get on to our live Q&A. Thank you to everybody who's been sending in the questions. There's still plenty of time to do so keep on doing so. But the first question I see that's just come in looks one for you, Chris, on the FS risk side. What process do you go through when helping to create a strategy around FS risk management?
Yeah, thanks for that. And you know, I've highlighted a few of these previously on when I was speaking around the consultation process, which is really important. So you know, the understanding piece is extremely important from our side. And just to echo, that's, you know, understanding the risk exposures, you know, appetite and experience of the client, you know, identifying those goals and objectives, and then going forward to execute and manage that thereafter. So, you know, just to echo my previous point, you know, what a real big fan of in terms of, you know, the process around FX is that collaboration piece. You know, I appreciate that you lean on us as the experts, and that's absolutely natural, but equally it has to be a collaborative process to make sure that your provider meets your exact objectives, you know, in the way that you expect.
I've just had another one in, Chris. It may be a follow-up for certainly for you or Mark. Could you please throw us some light on how to hedge exchange rate risk? Yeah,
again, I'll take that one. So, you know, what I don't want to do is get into specific niche products on this call, because there are far too many and it's probably not the right environment. But there are products out there which enable you to protect against adverse currency movements, depending on what side of the market you are. But equally, a benefit should the market move in your favor, and that's a proportional benefit. And there are many strategies and solutions out there. But I think the point I'd like to highlight is, again, it's that bespoke piece. So if we have a good collaboration and I understand as a consultant exactly what your market sentiment and risk appetite is, then I've got multiple processes that I can go through to provide a strategy to you which almost meets that bespoke objective that you're after. And that could be, you know, your viewpoint could be that the market is going to move against you. And then I could say, well, actually, is there a scenario where we can provide a strategy where you might benefit if the market moves against you rather than in your favor? So it's really down to that understanding piece. But again, you know, I'm happy to speak about specific and niche products after this call individually. But, you know, as an overview, there are definitely areas and solutions out there for you to be able to protect your bottom line from adverse market movements while still benefiting if the market moves in your favor.
certainly the case it seems that bespoke is king on this occasion then.
Yeah, indeed. Yeah, I think that's really bad.
Technology. Iain, what do you see? This is another question, just getting on this point. What do you see will be the impact of blockchain and other similar technologies on supply chains in the future?
That's really true. We had the very similar question on Monday, actually, Simon. So I wonder if it's well, it can't be the same person trying to see if I get the same answer.
Testing your answer, Iain, on this one, I think.
I mean, I think the impact of blockchain on supply chain is, I mean, blockchain was invented to create, greater levels of assurance and greater sort of accuracy through access to multiple data points and data corroboration points. So the benefit for business, for manufacturing in particular, I think is a massive reduction in and possibly almost the elimination of supply chain errors that cost millions of pounds a year. If you so apologies for anybody who was listening on Monday, but I'm going to sort of jump into the same examples I give. So, if you look at Tesco and the horse meat scandal, if there had been a distributed network technology solution, which is actually blockchain is a brand name for a particular distributed network technology solution. If there'd been that in place that actually tracks the meat from farm to shelf, then Tesco would never have had that horse meat scandal. And in that respect, Alliance, Asda are currently working with IBM to address food contamination issues using IBM's own blockchain solution. And another one that I had experience of a little while ago was De Beers. De Beers, the diamond merchants, are using blockchain to keep conflict diamonds out of the retail system. So you can see, use cases all over the place that enable people to track product movement and product origination and product validation. If something has a process applied to it, like a diamond, so it goes from mine, to cutting, to polishing, to retail, and so forth, you can track a particular diamond or a particular product through that entire process by blocks being completed. The blockchain is completed, so that at the end of at the retail end, at the customer end, that you've got what you thought you were getting, and where it's come from, and whose hands it's gone through. So I think that sort of technology creates supply chain transparency and validation, which delivers huge levels of quality assurance. And I really don't think blockchain will be sitting in the financial services sector only or mainly very much longer. But I do think there's an acceptance issue with blockchain. It's so new, it's so different that that businesses do need to get their heads around actually what the use case is and how it can be useful, and also not just jump into trying to make a blockchain solution work when actually you're trying to fit a solution to a problem that doesn't exist. And that's another thing with it.
Yeah, I think it's really interesting that quality, I think, is an essential ingredient of any supply chain, but probably more so in the current marketplace. This looks like another one for you, Iain, or Nicola. What do you think are going to be the main challenges in managing the supply chain as we go through the 2020s? There's a decade question for you, Iain.
You want me to take it, Nick?
Yeah, go on then. That'd be great.
I think we've just talked about creating a robust system that's fit for purpose. And bearing in mind that the purpose that they need to be fit for is changing faster than you could ever imagine. As a result of external influences, whether it's the pandemic, whether it's political influences like Brexit, whether it's commercial influences like the final mile, the revolution in final mile delivery, for example, with Deliveroo and Uber Eats and so forth, spreading out to cover much more than just food deliveries from restaurants. Other challenges, digitalization inevitably is going to be a challenge that business is going to have to get to grips with, and even more than they have already. dark warehouses, dark kitchens, bot-operated warehouses, where you've got something the size of Derbyshire with 3 people in it and 100 robots. Those sorts of issues. There are all sorts of risks and liabilities. Who's responsible if a robot malfunctions, causes a fire and burns the thing down? Was it the robot manufacturer? Was it the outsourced operator who was operating the robot? All sorts of issues there that people are going to have to get their heads around. And I think, Luke Dixon would have covered it yesterday in the data piece, but massively increased exposure to cyber risk and the need to protect, and control personal data. And I think inevitably, what comes with robots, what comes with automated vehicles, what comes with drone delivery, etc., is increased regulation. And so increased regulatory compliance, I think, is going to be a key feature that will add further admin and add further cost to businesses, which they're going to have to work out how to absorb or pass on. Sorry, that was a bit of a depressing answer, wasn't it?
But it was a good answer, though. Right, I think this one is for Chris and Mark. What are the most important factors to consider with FX decisions?
Yeah, I think I'll take this one again, Mark, if that's all right. I highlighted those steps earlier that we as a business go through to help you understand where the risks and opportunities sit by analysing your objectives and what you require. Now, internally, we really do view this as an ongoing partnership as opposed to a one-off transactional relationship, because trust and understanding are important factors, and that takes time to build. But where I would place the most value in the process is in the initial understanding piece. Now, that's understanding around the red lines on target rates, whether that be for a container or a project or, a budgetary year as a whole, for example. But gaining insight into your risk tolerance is really important too. Where are you currently from a protection perspective, and ultimately, where would you like to be? It's that kind of present state and future state scenario. And without that listening and questioning element, we can't understand. So what I think is really important is having a reliable partner who is trusted enough to question, to probe and to challenge, but also to, has a solid understanding of your business as well. And risk appetite and motivation is vital within that. I suppose the last point I'd make is that time is really precious right now. And by understanding and providing you with a sound strategy information piece and some analysis or MI, I suppose the largest gift we can give throughout that process back to you is time, which is vital right now.
Excellent. Now, this is one for Iain and Nicola. I'm going to let you battle over it. What actions do you take when you take on a new business critical supplier?
Me? Let me start. You can chip in.
I'll chip
in. I think we've covered some of this. In fact, I think Nick mentioned it earlier on to some degree, and that's there are certain safeguards that you can put in place. I think when you're entering into any new arrangement with a key supplier, and this isn't legal because this is all pre-legal. This is pre-contract. And some people call it due diligence, other people call it common sense. But investigate. I guess you start by investigating their suppliers. In fact, I'd probably start with looking at the press. Frankly, I'd either jump on the internet and do some press searching, or I'd actually, depending on how critical it is, you can go to various agencies and actually get a sort of report of all press reporting on any company for the last 12, 24, 36 months. And I'd do that if it was a really important supplier. I'd want to know what they've been doing, what results they've been reporting, what scandals there have been, what legal cases they've been involved with, what innovation has been attributed to them, all sorts. You just get all that through the press.
Yeah, it's all about their trading history, isn't it, I guess, and just looking at, what they've done good, what they haven't done, and, what they've done bad, maybe, credit history, finance, and sort of addressing that with putting extra securities in place, like parent company guarantees, for example.
Yeah, I mean, that will, if you look at their financial, you look at their accounts, you look at the finances, you do you get a Dun and Bradstreet or a Standard and Poor's report on them, for example. You look at their reputation, you look at their stability. That will tell you, do you need, as Nick said, do you need some sort of performance guarantee from them? Is there a parent company? Is the supplier that you're looking at, a UK subsidiary that's been going 2 years and has a balance sheet of 6 and threepence, but which is a subsidiary of a huge German or French or Spanish, whatever, business, in which case you want to be looking at the parent company for assurance that the UK sub is actually going to do what it's supposed to do and will stand behind its liabilities.
Yeah, and maybe building in, and just sort of parent business continuity plans and seeing what what the backup plan would be if everything went wrong, and seeing what they sort of suggest in terms of that, and what detail they have around that as well, because all of that just shows that they're sort of prepared for these kind of things.
Yeah, no, I think that's a really good point. I mean, that almost then takes you into preparing, to put the contract in place, and I would say this, wouldn't I? But there is no excuse for taking proper legal advice, in relation to those contracts. I think there is a tendency there is sometimes, and in fact we had this yesterday, where a client, because they're looking after the pennies, downloaded a contract from the internet and said, well, we've put this in place. What do you think? It was a bit of a shame they asked us what we thought after they'd signed it. But I think take proper advice, because actually the point that Nick's just made is, and the point we made earlier on about getting proper management, contract management provisions, getting a provision in your contract where actually you put an obligation on the supplier to produce a business continuity plan or a disaster recovery plan, whatever's appropriate, to deliver that to you within 2 months of the contract being signed, and that it's got to be agreed and it's there and it's sitting there. That's part of that, creating that congruence, so that you and the supplier jointly are prepared for something that might come down the tracks and and derail things temporarily.
And there's a balance, isn't there, I guess, in terms of putting too much obligation on them in terms of administration and reporting, against that affecting the ability to supply. So it's sort of getting that right balance in terms of you getting the right information that you want, but that not interrupting the day job sort of thing.
Yeah, spot on.
Good. I mean, time seems to be going against us at the moment, and we've had a lot of questions coming in, but we probably have time for one last question. It's one for the panel. Does the panel believe that a business must see its relationship within its role in an international supply chain, and market capture is now a collaborative game rather than a competitive one in mitigating risk? Is that one for you, Iain, to have a go at?
I'm not sure I understand the question actually, Simon, but just
read it again.
Yeah, please. Yeah.
Does the panel believe that a business must see its relationship within its role in an international supply chain, and market capture is now a collaborative game rather than a competitive one in mitigating risk?
Yes. With 30 seconds to go, my answer would be yes. But I think an awful lot of what we've talked about, it has been around that collaboration. In fact, we saw from the poll actually that the audience actually feels that is indeed the case, that creating a collaborative supply chain, and for manufacturers or producers to play their role in that bigger piece of collaboration is absolutely the right way to go. I mean, I think we're even going to see, I was interested that not many people identified the fact that they're looking to integrate the supply chain. But I think, as time goes by, that's something that I mean, only the really large businesses probably are in a position to try to integrate the supply chain. But that's the ultimate demonstration of collaboration, when actually you bring a key supplier effectively in-house in order to secure that supply, that business critical supply. So Sorry, I started with a one-word answer, yes. I've waffled a little bit, but I'm going to go back to yes.
Anybody else have a comment on that last one?
Yeah, I mean, I would agree with everything that Iain has said there. I believe that in challenging times such as this, collaboration is critically important across all parties within a given supply chain, to work together to deliver the end goal. Collaboration is always more productive than going head to head. And although we all must remain competitive within the expertise that we provide, it's collaboration that can help achieve a joint win, and that there is an example of good collaboration is Western Union and Fries working together in forums such as this to try to bring our respective expertise to the table and try and deliver better value than we could do individually. So
yes, I think we've certainly covered collaboration, quality and risk, haven't we? And I'm afraid time has beaten us, everyone. So may I take the opportunity to thank you all for joining us. Special thanks to our panel, Iain, Nicola, Mark and Chris, for their thoughts and insight, and to Simon Pick and Tom Williams from my team in bringing all this together. We will be following up with you all the next few days with answers to any unanswered questions, details of our next webinar, and a copy of the recording of today's session. Thank you once again for joining us, and please stay well and keep safe. Thank you.
Thank you.